On behalf of Left Lane Capital and AWS, I'd like to welcome you to New York Tech Week and to our event this morning. Thank you for joining us. My name is Jason Guzman. I lead the venture capital and startups team for AWS. I get to work with the most amazing investors in the world and the incredible founders that they back. Really glad that I could join you here today. Today we have an amazing panel for you. We're going to be talking about metrics and data that matter in A and B rounds. So if you're raising an A or B round, this is going to be particularly helpful for you. And amazing panelists that we have today. So Issam Freiha, who's joining us from Blank Street Coffee, where he's the CEO and co-founder. Priyanka Jain, who's the CEO and co-founder of Evvy. We also have Scott Lynn joining us, CEO and founder of Masterworks. And moderating the panel is Harley Miller, the CEO and managing partner at Left Lane Capital. So with that, you guys start with the panel.
Awesome, thank you. Oh, is this on?
I think you're not on.
I
think this is actually low.
Try again.
Check. I think you guys can hear us anyway. Yeah. I think I can project. Let me know if it comes on. Thank you so much for having us. It's a real privilege to be able to host this panel and participate in this ecosystem. You know, as folks may know, we're a relatively newer firm, kind of a newer kid on the block. So we are largely a spin out from Insight Partners. We started in 2019, and so we too are a startup, kind of building our company and firm brick by brick alongside all the other great founders and operators here in this room. And I'm privileged to welcome 3 of our portfolio companies on the stage, so I will acknowledge any tacit or implicit bias here. Yeah, exactly. But maybe just for everyone's edification, we could just start and just kind of go in sequence of introduce yourselves and a bit of your founder origin story and what your company does and kind of roughly stage scale profile where you're at.
Sure. So my name is Scott Lynn. The company that I'm running now is called Masterworks. So we allow people to invest in paintings by buying shares in individual artworks. I think there's a couple of people who are actually investors here today. But yeah, Left Lane invested in October of 21. It's technically a Series A, kind of a Series B round, but yeah.
It's just a letter, I suppose, right?
Letter.
Yeah.
Nothing else? You don't want to?
That was it.
Amazing. I'm Priyanka. I'm the co-founder and CEO of Evvy. Evvy is a women's health company specifically focused on female biomarker discovery. So thinking about, given that we only studied men until 1993, what are all of the data sets that we're missing on the female body that would enable us to unlock better diagnostics and therapeutics that are actually effective in women's health? And we're focused on vaginal health first and the vaginal microbiome and the ways that we can use that for vaginal healthcare delivery, as well as better risk prediction around things like fertility, pregnancy, cancer progression, and more. And we are consumer facing today. We have a vaginal healthcare precision testing and care platform, and Left Lane led our Series A just in August.
I'll make a quick note. We've actually backed the kind of the sibling pair of Jain. So Priyanka's older brother is the founder and CEO of Built Rewards, but I'm steadfast in that you are the better.
It's an ongoing competition. Harley spoke with my brother yesterday, and the question is who's going to be better?
Hey.
I'm Issam. I'm the co-founder and CEO of Blank Street. We're a 3-year-old coffee chain. We serve customers in 72 stores across the US and the UK. And our core founding insights, the question we always get is like, how are you different? Is we really simplify the shop and the operation that surrounds it to create a new quality customer service and price standard for daily coffee consumers, while paying our baristas 40 to 50% more from a wage perspective. So yeah, that's a bit about Blank Street. You just sound a million of these.
Yeah, awesome. So I think one of the things that we are and broadly speaking, Left Lane is a Series A, Series B kind of internet and consumer tech oriented investor. And so as a firm, we talk a lot around growth vectors or kind of our internal nomenclature is Act 1, Act 2, Act 3. And most companies at the Series A are in their first act or figuring that out. And I think it bears the question around, future growth vectors, what can you pursue? Sometimes there's questions from investors around market size or addressable TAM, right? Maybe we start with you, Priyanka, as you just closed a Series A, and admittedly the business is performing really well, but it's largely today from a sort of a business model, a testing with a virtual care option. How do you think about kind of evolving and how do you sequence in growth and not get distracted and make sure you're taking on too much at any given time?
Yeah, that's a great question. So like Harley said, we currently offer essentially think what 23andMe and Ancestry did for the human genome, we're doing for the vaginal microbiome. So our key kind of innovations are the test and then the precision care platform that we built using the data from our test. And as Harley said, we're really excited that we work with almost 30,000 patients. We've been able to really elevate the standard of care for the number one reason that women go to the doctor, which is amazing. But I think when we think about the long-term vision of Evvy, we started as a data company. Our interest has always been in how do you actually build these data sets that would enable us to deliver better healthcare for women. And our end mission is not necessarily doing all of the healthcare delivery ourselves, right? And we really saw this platform as the way to get in the door and build the data sets. Could we leverage patients and their desire for better healthcare? Frankly, women are the people who are most incentivized for the healthcare system to improve for us. And I would say kind of when we went into the Series A, the main things that we felt like we had to prove were that, when we were raising our seed, it was, is this really a big problem? And is this a niche market? And will people pay for this themselves? So a lot of the Series A was saying, okay, we've definitely proven this is a massive market. People will pay for it. They will pay for it over time at scale. But that doesn't necessarily prove out everything we want to do next, right? So if we want to unlock novel biomarker discovery for point of care diagnostics, or unlock new therapeutic targets or molecular signatures that could help us better treat PCOS or endometriosis, those are a lot of steps further along than where we can go. And I'm curious what your perspective is on this, but I feel like we went into the round saying, okay, we've de-risked what we can do in vaginal healthcare. The number one reason women go to the doctor, we can prove that we can do it, profitably at scale and really improve outcomes. And then I felt like, our story long-term was not just doing more of that at scaled, it was also thinking about how do we unlock these new opportunities for the business. And I felt like our primary responsibility in asking for capital to do that was to say, here is how we validated how large each of those opportunities are. And then for us specifically, it wasn't just saying, here's the math behind the market size, which obviously is fundamental. It was also saying, here's the science for why we think that our platform can go after these milestones. And so I feel like we very much fit this kind of act, or we call it Evvy, the phases of the company, and being really focused on what do you have to prove right now to even earn the right to do what you want to do next, and how do you sequence things so that when you go after the next opportunity, you're X times more likely to succeed or do it better than anyone else could if you had done that first.
That makes sense. And just to follow on that, do you feel that you'll get pushback at the next round if you are just still doing what you're doing today 3 or 4 times larger, but you haven't sort of entered into that next phase with some demonstrable proof points?
Seems like a question for you.
We'll see.
No, I mean, I do think that for us, it's kind of like, where is the ceiling on where a company can be, right? If we only own vaginal healthcare, that's a $3 to $4 billion revenue opportunity, but it's not a $100 billion revenue opportunity. So I feel like it's less of, can we continue to be a venture-backed company, and more, where is the ceiling on what we can be?
I mean, Issam, let's move to you in Blank Street. I think as you move from a kind of a venture company to a growth company, and I think that's where I would characterize Blank Street. How do you think about more of the same, right, and just continuing? I mean, and your model, right, is run micro retail tech enabled coffee chain, right, and so I would imagine a second phase for you should not be something like, well, we're going to go launch a froyo chain right off the backs of that and distract yourselves. How do you think about other growth vectors? And I think that can come in different ways. That can come in geographic expansion, vertical integration, right? Menu add-ons, or maybe help the audience understand where your internal strategy is, as I know you are obsessive about that as a CEO.
Yeah. So taking a big step back, to set a strategy, the first thing that you're doing for your investors and yourself is trying to grow your equity value. Your equity value is a mix of, broadly speaking, 2 things. The short-term predictability of your core business and extending the free cash flows on that for the next 3 to 5 years, and all the activities that promulgate that. And then your long-term value, which is investors asking, what are the proof points that this is going to be a really large business in 10 years? And at different phases of fundraising, those 2 things matter or investors weigh those two things differently, especially in a market like today where predictability is so much more valued. The initiatives that, from a strategy perspective, that you should be setting should be more tailored to what are the things that we're doing today to make sure that the business is really predictable from a cash generation perspective over the next 3 to 5 years. And so that's broadly speaking how we think about it from an academic sense. And breaking it down for us at the Series B, the question, the focus almost entirely, 90% of the business was the core business, doing more of the same, better, and with relatively less resources. So nearly every board meeting we start is like, are you doing more with less? And the answer is, in theory, should be yes. But that's really been the focus for us over the last year or so. At the same time, focusing on the core business, there is 1,000 growth vectors for that. Like, it sounds simple, but you could do so many things to make the operating model more valuable to customers and just more efficient in general. But at the same time, you can never lose sight of the 10-year vision, because ultimately that's why investors back the business. And so what we do, before the fundraising milestones, is always try and prove that we have set particular initiatives, or we have proof points that we're building towards moats that are going to exist in 10 years around our brand and our supply chain and our products. And at the same time, there are real proof points around how big this business can scale, even though we're not really committing that many resources internally from a cash perspective or people perspective. And so those things add to the narrative, but they don't add to the cost of operating. But yeah, to answer the question, for us, it's at least for the next 3 to 5 years, just doing more of the same for customers, but in more markets and with relatively less resources.
Yeah. How do you think about the nth store in the greater New York boroughs versus the first store in a new market? What's that internal deliberation like?
The first store in the New York
sorry. The consideration between launching the 50th store in New York versus the first store in New Market X.
Well, the first thing in building
and sorry, specifically through the context of investors, potential new investors looking at you and saying, well, you're currently in 4 markets.
Yeah.
I'd rather you be in 10 markets, but have half the store footprint, right?
Yeah, of course. I think there were 2 considerations there. From an investor perspective, going in, it was never a challenge for us to describe how big this business could be, because it's a $80-90 billion market in North America and Western Europe, which is where we're addressing these problems. And then there are $10 billion plus coffee chains that exist. So it was never a challenge to explain this can be a really big business in a few markets. But I think what was a real challenge is a much bigger challenge that there is in building a consumer brand early on. Ubiquity can kill magic. And so crowding too many stores in a single city at one given point in time for consumers removes the magical element that Blackstreet can provide. And so for us, it makes a lot more sense to distribute the growth across 5-6 cities. And that's like one of the main probably mistakes we had done early on in scaling Blackstreet, where we were so focused on New York. And we believed that New York, say, $2-3 billion coffee market, so we could just be huge here and just absolutely focusing all the growth here, when to the investor that could make sense, but actually to the customer it removed that element of magic in what we were doing. So yeah, from both a branding perspective and from a branding perspective, it makes a lot more sense to be opening a lot more markets. But I would say from a business perspective, it obviously complicates. It requires a lot more resources, a lot more coordination. You dig a very big G&A hole every single time you open a new market. So there is that consideration as well. And it's taking a balanced approach at the end, which is what we're doing.
Yeah. Scott, I want to have you address for the audience. I think what you all do as a company, as a tech company, as an asset manager as well, I think that was a bit esoteric or abstract, I think, probably at the beginning. And there's been a wave of fractional investing in everything, whatever, Pokemon cards, collectibles, right? How did you have to kind of combat through the sort of false comparisons of what Masterworks does, whether it be from your business model, your data moat, and what allows you to be, the firm to be, Masterworks to be the best in the world at what they do, and unfair comparisons to, other similar companies. Yeah.
Yeah, I think from our perspective, like one of the challenging things in this like collectible space broadly is obviously we focus on art, and there's a whole bunch of data on art. Like people don't appreciate that art has been sold for hundreds of years at public auctions. Sotheby's is 275 years old. So there's a big amount of data that you can look at.
How large is the asset class roughly?
It's a roughly $1.5 trillion asset class, $60 billion trades hands every year. And I think the challenge that we had is when we looked at asset classes like NFTs, classic cars, watches, there just wasn't enough data to really conclude that those things were necessarily appreciating. Like we say that about NFTs today, and people today appreciate that, but like a year and a half ago, there were NFTs that were selling for $10 million, $20 million. So people assumed that it was appreciating, but there are a lot of NFTs that would go into these marketplaces and never sell. So, I think part of the core thesis of Masterworks is that when you look at art as an asset class, it appreciates greater than public equities, but there isn't a way to invest in it. So we really, relied on data to conclude that.
And how much have you leveraged PR and earned media and sort of carrying the torch as a founder to kind of continue to just drill that message into the retail community, investor community, press, and otherwise?
Yeah, I mean, we leverage PR and earned media a lot. I would say though that it's mainly effective in our funnel. So we try to put a lot of the earned media that we do in our onboarding funnel for trust signals, so people kind of can believe in the asset class. Like I think our job is particularly hard because there's no pre-existing intent for investing in art, right? Which is a fundamental marketing problem because we can't go on Google and just buy the keyword invest in art, like nobody's searching for it. So we have to build intent. So we do that a lot through earned media.
Okay. I want to switch gears a little bit. For anyone who's probably interacted with folks from Left-Lane, we're a pretty data obsessive group, right? As a consumer internet investor, an earlier stage venture growth investor, I think that's fundamentally important, is just understanding the mechanics and growth levers of a business, thinking through LTV CAC and retention metrics. All three of you could certainly attest to that as it's a core area and focus of our diligence, certainly not exclusively, but there is an upfront, analytical component. Maybe Scott, starting with you, describe kind of what that looked like, how, what the process was like, especially as, it was I don't know whether it was a Series A or Series B, but it was first, for all intents and purposes, your first institutional round. It was a large round and a large price. How important was kind of owning that data narrative?
The price was that large.
Well, on an absolute basis, it was larger than the traditional Series A or early Series B in an impressive way and in a deserved way. But how important was that data narrative and kind of the back and forth sparring during a diligence whether with us or prospective investors, and kind of what were the varying experiences you had?
Yeah, look, I think it's interesting. So Masterworks is my
12th company.
It's 7th, 8th, 9th company, something like that. So I've raised capital for many years from different firms. And I think it's super interesting to see the evolution of that. So if you go back to like 2000 or early 2000s, the diligence process for raising a Series A or a Series B was basically like an interview process, right? Like the investor would come in, interview management, interview different team members, talk about like TAM, it was definitely not data driven. Whereas I think if you fast forward to today, it's more about like, give me all of your customer cohorts and let me analyze them. So I think the world is changed from that perspective, and that's really, I think, your guys' approach to diligence more is looking at data. And I think that's frankly a much more predictive process, right? Like interviewing people is not, I think we all know is not a very predictive process. So yeah, I guess if I think about sort of a seed stage company going into Series A, like in my head, I'm thinking about what is the operating model and what are like the key risks in the operating model that I need to prove out. So if I need an LTV metric to have a customer that invests 6 times in the future, how do I get a bunch of customers in and see how many times do they reinvest in the future? Is that number greater than or less than 6? And then I now know that component of the operating model is solid. So I guess that's how I would think about like early stage is like, what is your operating model that you need for the business to be successful, and then how can you test each of those different components over time with real world data going into the Series A.
And how important is it for different functional leaders to really understand that math, that calculus at its core, or is that siloed to you in marketing or you in product?
I mean, in our business, like we everything we do is very data driven, so I think it's a lot of the data that we use in different groups is very complex, and other groups don't necessarily understand that. But I think the high level data is important for everyone to understand, right? Like everyone needs to know that our cohorts need to grow whatever 6, 7, 8% a month. They need to be tracking like how much capital is coming from existing investors. What is their LTV to CAC on new customer acquisition? How does that play out in terms of like how much income we generate every month? Like, so I think the high level stuff is important for everyone to know.
Maybe Issam, if you want to follow on that, I'd be curious how, as your business got more mature and you had more units under in the portfolio, kind of what metrics changed over time, or what evolved from when you were going to raise your first kind of institutional round or the Series A to the last round?
I think
as far as investor focus.
Yeah. Well, I think just broadly speaking, decision making as you scale gets a lot more complex. And the framework internally that we use, Amazon framework, is around, very simply put, in practice, you can segment all decisions as one-way door decisions, which are things you can't reverse, and two-way door decisions that are easy to go back and forth. And the number of one-way door decisions materially increases, and their impact materially increases on your business. So should I be acquiring this business? Can I be changing the loyalty program? Do I change the roast profile of the coffee? So all of a sudden everyone tastes something different. And those things happen a lot more frequently the more customers you have. I think that you fall into two risk buckets. The first one is you're over-optimistic as founders, always, and you underutilize data to make these one-way door decisions all the time. And that's usually like a lack of energy of trying to get benchmarks out there and actually understand what makes a great company or what makes a great initiative there. And then the second risk, which is equally like as dreadful, is being overly conservative as you scale and overusing data for two-way door decisions. And then you stop experimenting, you stop the startup culture basically dies a bit. And I think for us, it was it's been a process of adapting the culture to that and making sure that we can very clearly be able to understand what's a one-way door decision, what's a two-way door decision, and making sure that the team has abundant clarity on those things, so that we know when it's a one-way door decision. We have to be way more deliberate. You have to explain every single number, fetch as many benchmarks as possible, explain it to the board itself, and pre-rationalize the decision as much as possible. And that's just avoided so many mistakes that we could have made over time. I think that's in general how we've changed the usage of data, but it requires so much more energy to be able to get internally as a culture to be able to push your team to make sure that you're accumulating lots of data to make these one-way door decisions, which happens a lot as you scale.
And Priyanka, maybe just quickly, having just raised your Series A, what were the North Star KPIs or data-centric questions and in Diligence that you experienced as a team?
Yeah, it actually was really interesting because the various different investors we talked to had such different perspectives and North Star metrics that they cared about with our business. And I think when you have this kind of phased approach, people see the massive opportunity on one side, but there's so many different ways you can get there. And almost because we took a revenue generating approach to get there, it was almost harder because then people had something to ask questions about. And sometimes I feel like there were a cohort of investors where it actually would have been easier for us to just
be pre-revenue,
be pre-revenue,
be worth more,
been paying for the data to acquire the data instead of having customers pay for it, and people would have understood that better. And I feel like it was actually hard to find investors that were both willing to do the very intense, data-driven analytical work on our existing kind of consumer business, and we're capable of doing that. And then we're also capable of understanding the opportunity on the other side and why not being pre-revenue is actually a smarter opportunity for us. And so I would say we definitely had some, as we were discussing, more West Coast facing investors that were but you can just like pay for all of this data, and why worry about the consumer business, and why worry about generating revenue when you have this huge opportunity on the other side? And I feel like we empathize more with the left lane perspective of there's actually an opportunity to compound the size of our business by being revenue generating first. And so I feel like the North metrics that we held ourselves to were the same ones that you guys did, which is why it was a great partnership. But I will say that they were not the same across most investors.
Fair enough. Two quick questions, and we'll open it up for Q&A. You've run a lot of companies. You've founded or incubated, founder, CEO. What kind of organizational evolution is necessary as you kind of go from that 0 to 1 as you get into higher gears, and how do you think about leveling up team without not specifics per se on any given people, but just you're a tenured entrepreneur. I think
about that all the time.
Yeah. We discuss it a lot often.
Yeah, I mean, look, I think early stage is all about finding product market fit. So I think when you're in that stage of finding product market fit, like super fast iteration is really critical. Like I see so many founders that have this like defined vision of what they're trying to build, and like they keep trying to build it, but it's not working, and they still keep trying to build it. Like that just like moving fast, iterating, changing quickly, I think is really important. So people on your team that can do that, I think is really critical. And I think those people are pretty rare, actually. Like I think they're the exception rather than the rule. But I think at some point you transition from product market fit to scaling, and I think the skill sets differ, right? So that's much more about process, and I do think of process as kind of the distinction, right? Like heavy process in early companies, I think is a horrible idea, right? Because process is all about efficiency, right? Like you really don't care about efficiency when you're trying to find product market fit, but when you start to scale, it becomes more and more important. So I think the skill sets change, and that's always a tough transition from a team perspective. But yeah, that's what I think about it.
Maybe just on the same vein, as a bit of advice for if you had one thing to offer to folks who are out starting their companies right now, or trying to find that product market fit 0 to 1, what would you, Priyanka and Issam, have to say?
I'm thinking about it. Maybe you have the answer.
I mean, I think that if you start in an area, well, one, I just think there's so many massively if you already have a company, I have less advice for you, maybe, but if you are looking for areas, I think there's so much white space right now. And I mean, obviously I'm biased, but in women's health is a great example. And I think finding areas where there is massive market spend across different players, and then like nothing is an obvious place to go. And I think for us, what we found is really, really valuable was not traditional marketing as kind of the first way that we went to market when we were iterating really quickly. It was actually with online communities that we found were like massively passionate about this topic because they had nowhere else to go. So we were really iterating with them, and when we kind of hit a stride with them, we realized like, okay, we have something that now a larger market can understand. But I would say from a fundraising perspective, a piece of advice I would have is that I feel like whenever you talk to an investor, the thing they're trying to understand is what is the big assumption you're asking me to make for what your business to be massive. And for us, it's like, is the vaginal microbiome gonna matter? If you don't believe that that's true, like you should not invest in Evvy. And so I think there's like trying to actually be really upfront about this is the fundamental risk I'm asking you to take, and here are the reasons why I think I'm right. And then iterating that at every stage of your business. At the seed stage, the fundamental risk was, will people pay for this? Are there enough people who will pay for this? Can you be profitable? At the Series A, the next fundamental risks are, is the vaginal microbiome translatable to IVF success rates, to preterm birth rates, et cetera? And I found it much more helpful to just be transparent. These are the 5 biggest risks to why we might not succeed, and here are all the things we've done to de-risk why we don't think those things will be true. And that's actually how we orient the team's goals, are around really de-risking the biggest reasons why we wouldn't be a massive company. So I think just being transparent about that earns you a lot of points.
Cut to the chase.
Yeah. Just like you're trying to figure that out, so I might as well just tell you and then tell you why I think I'm right.
Maybe I'll answer a bit of a different question, which is for the purposes, I guess, of this audience and the panel, what's the best advice to raise money from a firm like Left Lane or like very data driven? I think we've spoken a lot about how the process has changed, and firms like Left Lane, I think it's table stakes right now to have good data and just to be able to deliver good data in a way that's easy for them to visualize and understand and get a meeting even in the first place. I think all companies at the Series A, Series B stage need to have some level of need to have product market fit nailed on, but at the same time, like some sort of growth flywheel, like great unit economics, cohorts that make sense, and that all that work gets done asynchronously, but only gets you a foot in the door. I think that's the important thing. And there's a great quote by the president of Ford who says, car making is 100,000 rational decisions in search of one emotional decision. And that's typically how investment decisions get made as well. It's all those rational decisions getting made around your cohorts and the ROIC of the business, and how what your NPS score looks like. But then ultimately, I think Lafayette invested in us because of like the fern or pistachio green color. Like that a lot. So you gotta, I think. but yeah, that gets you over the line. So I think it's like finding what that when you're meeting with them in person, I think it's really important to have the narrative shift towards why you're doing this in the first place, and what's unique about the brand, what's unique about your story, what's unique about the founders, and that's typically where the decision will get made.
Yeah, I think from my perspective, having a good command over your data is absolutely critical and necessary, but it's not sufficient, right? And it's that last emotional push. With that said, I think when you see sloppiness or lack of that financial hygiene or command, or a founder sort of pairing that off to other people within the organization, especially at an earlier stage of the Series A, I think that's a major yellow flag for us and a bit of a question mark. And I think just what we look for is founders who have, it's like the palm of their hand. They have a command over that. Of course, over time, I think it's still important that they're always having kind of a finger on the pulse there, but it is something that we look for. And I think as founders out there looking to raise their first institutional round, of a bit of more scale, as you kind of get into $10 million plus, I think it's critically important, at least in certain schools of thought and maybe the East Coast state of mind. All right, maybe how are we doing on time? 10:45. You want to open it up to? We can open it up to Q&A.
Thanks for sharing your stories. I have a question for everyone, including Harley. Has there been a book or article or even a conversation that has had an asymmetric impact on your success?
Yeah, I'll take that one. The one book specifically that we still use, I've used it every company I have. We just did one 2 weeks ago at Masterworks. Is actually super old school, but competitive strategy, Michael Porter. It's just we've always followed that. I've always followed that framework for every business that I've had. And it's funny because I think I go back to early on in my career, and early on in my career was all about I focused heavily on execution, just people, structure, process, getting shit done really fast. And I think what I realized later is it doesn't matter if you get shit done if you're doing the wrong thing. So I think that book is still, even now, people talk about blue ocean strategy and a lot of these concepts, they're all derivatives ultimately of 5 forces. So I still think that's the best.
Maybe I'll just go quick. Mine's actually more from a conversation while I was at Insight, probably circa 2011, 2012. I was, maybe an associate at the time, and I was obsessive about the sharing economy, and I was renting out my place on Airbnb when I would travel to Europe to try to find the next deal in Europe, and I would stay at an Airbnb, so I was properly symmetry as both on the supply side and demand side of that marketplace. And I remember pushing to try to get the senior partners at the firm to want to do that deal. And I remember one of the senior partners, whose name I won't mention specifically, told me, "That's absolutely crazy. Who the hell would let someone else stay in their home?" Right. And I was like, I literally am doing it on both sides. And there was a bit of that mentality, sort of a bit of a cottage industry mentality, which I think a lot of investors perhaps on the coast can be subject to and submit to. And it's only big when it's really obvious, right, in hindsight. And so that oftentimes stuck with me. And there's other examples of that. I remember I worked with HelloFresh and sat on the board, and it became a large outcome. And at a similar early stage, I had partners tell me no one cooks anymore. I was like, man, that is properly delusional. And so it's just as an internet consumer investor, I think you have to think through where you are in an adoption curve, and you have to. I try to have my own. Admittedly, there's personal bias, of course, but if you have the self-awareness to know kind of where you sit there and can you extrapolate that and try to sort of envision when you get to the deep in that bell curve or that histogram of the mass market common consumer. And I think if you can have that eye as a founder, as investors, or that kind of professional meeting of the minds, I think you have really big opportunities in markets and disruptive models to go after.
Did you invest in Airbnb or no?
Unfortunately not. If Left Lane existed 10 years ago and I were running the firm, we would have, but I wasn't in a position to kind of effectuate that. Maybe we'll move on to, unless you had any book article that really resonated you want to throw out, we could.
Do you have one?
Let's go to another
Yeah,
question.
Scott.
Yeah, go ahead.
So I have a question for Priyanka. I was very recently director of product at a health tech startup, so I can empathize with a lot of the work you're doing. I'm curious, from a quantification standpoint, direct to consumer is a very deliberate strategic choice as opposed to, say, working with payers. Could you talk a little bit more about why you made that choice?
Yeah, 100%. So problem is that nobody cares about vaginal health except for women. And so I think what we realized, and I think kind of similar to what you were saying, Harley, it's like, I think there's a massive opportunity where when you look at the objective data, you look at the fact that this is the number one reason women go to the doctor. They're more likely to be misdiagnosed than correctly diagnosed. They're more likely not to get better than they are to get better. And then you look at the massive market sizes of Vagisil, Summer's Eve, these companies selling washes, wipes, suppositories, whatever it is to make your vagina smell like a flower because the healthcare system has failed you. It's like clearly there is a massive healthcare problem and there's massive consumer spend that's already happening because the healthcare system isn't working for people. And I think that the challenge is that there's so little trust from women in the healthcare system because the healthcare system gives women so little trust, right? We get so little trust from the system. And so what we found was that women weren't even going to the doctor for these conditions anymore, or the vast majority of women who have these problems more than once, and where they were going was online communities. They were searching online. These are some of the most searched terms on Google, and there's no competition for them. So we realized, okay, there is a lot of consumer spend already, so I think we weren't trying to unlock a category where people were not already spending on healthcare, which I think is specific and important. And two, what we realized is that the system has no incentive to change unless the patients are demanding it. And so we realized, like, okay, we can start to capture some of this consumer spend where people have no information and people really want information. And then we can use that data to go to the people who wouldn't care otherwise. And so it felt like the only way we were going to change the system was to start with the patient. But as Harley can tell you, like, that's obviously not our only long-term strategy. I will say that I do think direct-to-consumer healthcare gets too much shit. And I have a lot of opinions on that I'm happy to talk about later. But I also think, like, you have to have, if you want to be a $10 billion company, you have to have a few more strategies than just that.
Thank you.
Yeah, one more question for Priyanka. So absolutely loved it how you talk about risk, de-risk and risk management and how upfront you are almost like a public company. So when you actually bring that conversation, do you put that on the slide deck? Do you talk about that right up front, start there? Yeah, if you can share more about it.
It's a great question. So we had I tactically can tell you, and I don't know if you remember this, but we had our first set of meetings really around that were more focused on the problem in the market. I think that's the first thing that investors want to understand. Is this even a big enough space for us to care about what you're doing? The second conversation was, how is the actual business doing right now? And that was a lot of digging into the cohort data, looking at the revenue, the CAC LTV, et cetera. And then I would say the third conversation was, okay, we get that you have this business, but if you're telling me you want to be this massive company, prove it. And I remember we came to their office and I was like, they're asking a lot of questions dancing around this exact question. And I actually put together a deck that was like, here are the 5 key risks to Evvy. Here's how hard I think here are the steps we need to take to de-risk them. Here's what we've already done. And here's how hard I think the things are that are coming next and what we've done to make those things easier. And so for us, it was kind of like the third conversation, but it was very much like on paper outlined, sent to them.
I think that's spot on, right? Because otherwise, it was a lot of, for us, it was hard to wrap your head around and just kind of cut right to the point.
So I guess this is a question partially for Harley because you see the market from your position and partially for Priyanka because you just were in market. But how have the metrics and benchmarks around Series A changed? Because I think if we were having this conversation 2 years ago, $1 million ARR was like, okay, cool, you have product market fit, you're ready for Series A, but that goalpost has definitely moved. So I'd love to get a sense from you guys of how much it's moved.
Yeah, and listen, I'll preface with the fact I think that Series A, Series B, whatever the letter, like that nomenclature means different things in different pockets of entrepreneurship in the U.S. and Europe and other ecosystems. And there's also different schools of thought. People or investors maybe who have more of a stated willingness to do something at Series A, Series, but it doesn't have revenue. And I think, at least for our purposes, we've been creative like that and flexible at times. But I think the majority of the time we want to see kind of real growth. That growth now needs to be ushered in with a new era of efficiency. I think a lot of them, and we have companies that we backed early and they're at, they've crossed the $2 million of ARR and there still doesn't seem to be a huge willingness to kind of do that proper, whatever you call it, A+ early B 8-figure round. Not all revenue is created equal as well, right? So, what's the underlying margin profile of that? What's the efficiency with which you've achieved that? Do you have, I think one of the things we look for specifically, and it's not about, I hate when an investor comes and says, like, if you're not at, if you're a growth investor, talk to me when you're at 10 million of ARR. Like, if you're, what if you're a marketplace and that's GMB? What if you're an enterprise software business? What if you're a consumer business with a physical product that's at a fundamentally low margin? Like, that's just a silly, really basic and narrow view of the world. I think what we look for is ultimately LTV to CAC, and do businesses have surplus? Like, are they growing fast and do they have surplus, meaning where like they can take capital and do more of what they're doing, but faster and sort of hit that next inflection point. And so sort of teasing that, I think that is akin to cash flow for a late stage growth or private equity firm, is what we view as like that arbitrage opportunity, not as far as taking advantage of a founding team or a company and investment, but just the ability of, like, at least for the coming quarters or year or so, you have a really good command over, like, okay, you're at 1 or 1.5 million of ARR and you feel like the forward looking few quarters you're going to triple, quadruple, right, because of that, versus the inverse of that. If you're at 2 million of ARR and you're growing really fast and you're like already past the efficient frontier of value creation and your economics are like razor thin, the harder you push there likely, almost surely, there's going to be further degradation. I think that's so again, not all revenue is created equal. There's a lot of the inputs that sort of kind of go into that cocktail.
The only thing I'll add to that is that I feel like what was really helpful for us was a little bit of what you were saying around benchmarking and knowing what's going on in the market. I think being able to go into the fundraise saying these are the 10 key metrics that a fund like Left Lane probably is going to care about. Where are we below the bar? Where are we at the bar? And where are we above it? And then really leaning into, for us, it's that over 70% of our revenue is organic. And I think that's like the number where we can really lean in and say, here's why we think that what we can do with more capital will continue to enable evergreen growth, and kind of leading the story with where you are excellent. But you kind of have to do a good job surveying the market and understanding how do my numbers compare to what everyone else is telling you. Because if I think my numbers are great and you look at them and you're like, every other company I met today is doing that better, like that's not going to show well for us.
Yeah, and your NPS was super high, the efficacy of the product, and I think that's what probably is some of the leading indicators of why most of it's organic. I mean, Masterworks, you guys were cash flowing when you raised that initial round. And so by definition, a business that's growing really fast, that's making money, probably has surplus economics, meaning they can do more of what they're doing today, and frankly, more aggressively and at scale, and continue to stay rather efficient.
Thank you very much, everybody. I think Priyanka kind of touched on that. I would love to hear what do you think are the white spaces out there, particularly in innovation?
Sure. Any thoughts? Well, I'm kind of trying to do that with Masterworks, but I think the interesting thing about white spaces, I guess this is just a general comment, is like if you think about companies like Uber, right? Like that problem was there forever, and nobody really thought of that as a white space, right? I think what we're doing with Masterworks, that problem has kind of been there forever. Like we think art is the largest asset class that's never been securitized, it's not investable, should seem obvious, someone else should have done it, nobody did it. So I think there's sort of this common attitude that like most white spaces are gone. I don't know. Like, I'm not sure. Maybe.
Definitely not.
Maybe not. So it, I don't know. I don't know what they are specifically, but
Yeah, I mean, I think as a firm, everyone has their own theses and things that are, for myself, I have to kind of maintain a little bit of a head on a swivel and process a little bit of what, is coming into us or what we're going out there and finding. I don't sit and overly purport to be some like big brain cerebral investor who's sitting there and whiteboarding and like hypothesizing about the ways of the world. Like, I'd rather just get out there and have as many conversations with bright-eyed founders who are like pushing that forward. I think if you were to talk with different folks from Left Lane that are throughout the room, you would hear different answers of where people are focused. And someone might say, I think right now, the era of retail fintech has some pressure, and so I would be looking for embedded, financial services, and this is more of a business model construct. Businesses that have inherent distribution advantages that don't have to just kind of continue to pay Facebook, Google. So I don't think that's a white space per se. It's more of just in the spirit of creating value without just kind of draining cash. I think we're seeing a lot right now. Like, if you were to look back 5, 6, 7 years ago, someone would have said, who the hell needs another project management software business? And all of a sudden comes along Monday and other related businesses that scale. I mean, I don't know where it's trading now, but at one point it was, meaningfully north of 10 billion market cap, and it's continued to grow at scale. I think you're seeing a lot of things within, broadly speaking, graphic design or the creative field, leveraging certain AI components, but kind of interesting new workflow software. I think for us, what begs the question of, is this a feature? Does this have kind of platform potential? Can you actually start to pick apart parts of Adobe or an Autodesk or other large platforms there? Some interesting things in 3D I find I've been spending time with, but on the same measure, sometimes it's not the most like world-changing thing. You're still seeing large markets convert from an offline analog behavior to a digital first or an e-com world. Take a look at pet food, right? Premium pet food. You've seen some really large scale businesses domestically like the Farmer's Dog. We've made bets in other geographies and that are much earlier in that channel penetration. So sometimes it doesn't have to be like this, change the world mentality. It's fundamentally a really big market. It's a really good business, and you have a 15-year long economic relationship with a customer.
One thing I like, particularly for ourselves, like we're replacing a product, right? We're not creating a net new market. And the way I like to think about it, and from day one when we were starting the company, is that we don't need to actually move the ceiling and push the ceiling forward of like what a great coffee shop can look like. All we have to do is raise the floor. And actually raising the floor, doing 10-20% better of what consumers at scale can expect is a massive business in and of itself. And what we do and like the value we would provide to the world at that point in time when it's done is that no other coffee shop would ever start if it's not better than Black Street. And that's like the 1, 2, 3 up locations that would start from there. So I think you just need to maybe like the news cycle and Twitter is like so bogged down in like and you see investors get really excited by things that are creating that new markets. And if you have an idea that actually addresses that, then you should go for it. But starting a company, just be really opinionated about something and start there. It doesn't need to be world changing for it to be really big.
Okay, but I have to add the other side of this. I obviously agree with all of that, but I will say, like, there's so many areas that we are finally just starting to put money in that are massive. And I will say, like, companies like Evvy and the massive amount of other women's health companies have started to do the market education. That will make it easier for hopefully the next wave. And just from a numbers perspective, it's like women are 80% of healthcare costs, control 80% of decision making, but we get 1% of R&D, right? Or 2% of healthcare dollars went to women's health companies. And of that, 65% of it went to only fertility and pregnancy focused companies because women are only our ability to reproduce, right? And I think there's so much opportunity and true, and this is, I'm amazed and grateful that Left Lane invested in this, but I think there's so much opportunity in basic science in women's health, which is the pitch I will make. I think that so much of women's health innovation has been lipstick on a pig, a better experience, more accessible, but it's the same shitty standard of care. And I think when you look at the massive value creation that frankly mostly academic institutions owned around basic science of men's health, all of that is up for grabs in women's health. Who's gonna own the basic science that powers totally new ways of diagnostics, therapeutics, et cetera, in women's health, and there's like no companies and no investment there yet.
At the same time, I think biotech, life sciences, as you sort of toe the line between that and what you're doing now, as ultimately kind of like, can you establish a new biomarker? Funding, there's a lot of headwinds right now in that market from an institutional capital. And so cycles matter, right? As far as you have a bold entrepreneur who dares to build something like that, but especially when you have to be patient. If you're a pure R&D and it's a delay, like that is not an easy exercise right now.
But that's why consumer is exciting.
Yeah.
Because women are desperate because the situation sucks.
All right, last, I think we have time for one more. Yeah.
Appreciate you making all this happen. There's been a flow of more, you're talking about your identity as consumer tech, and then your blank street. There's been a flow of venture funding going to more capital intensive four-wall concepts.
Yeah.
You see Summer, you see Wander raising a lot of money. How do you evaluate opportunity costs, and what made you fall in love with a four-wall concept?
Yeah, I wish one of my co-founding partners, Jason, were here, as he sits on the board, and I have to give him credit. This was really his thesis, something that he was obsessing about for years, was just looking at a really large market, a habituated spend that was established, and could you build a model that was better at a more affordable price. We are principally an internet and consumer technology investor, right? We've done seldomly some things but as of late, we have done things that have a physical component to it, right? I won't talk. We're looking at something, and that's another four-walled business right now, but it's growing really fast and it's meaningfully cash flowing. It's never raised capital. I think for us, there was a lot of investment into four-walled businesses, and I think there is a bit of a renaissance movement happening there, just because there's not been a lot of innovation amongst traditional operators or sort of traditional incumbents. For us specifically, we're looking for sample size, right? So, do you have a large N of something? What we are not going to invest in almost surely, and we get pitched a lot, is we have one location, right? The build out costs were high. It's a 3-year long CapEx payback. The AUVs are 4 or 5 million, and we're at 1.5 million, so we're going to get to utilization, but we want to raise $15 million right now to build out the next 3, 4, 5 ... and clinics or centers or whatever the industry is. And please give us a valuation that's reflective as if we've already done that. Like, that is just not a story that will resonate with us. And maybe there are other investors that have done more kind of retail, investing that understand that playbook. But I think, for us, it's looking at, return on invested capital, kind of the margin level, AUVs. I think we like things that have, where you could put a new blank street in the ground and the payback is very fast, right? We're looking at something, I don't want to say the name because it hasn't closed yet, but something will likely hit the press that we're looking at. I think it's all about capital efficiency, and you have to have a different skill set as an investor. And we've only got comfortable with that after having, I think we invested in Blank Street after having probably looked at a couple hundred retail or tech-enabled retail businesses. So for us, I think it's about the ability to, can you put units in the ground quickly, and can you have a lot of visibility into how that's performing, as opposed to, starting one clinic in, outside of the Boston area or outside of, somewhere in Manhattan, and then being able to extrapolate the next stores. I think that's a tough game, and so it's for habituating use case, something that, where the vast majority of your revenue any given month is going to come from power loyal existing customers. I think that's for us important, but it's, again, you can't pay a valuation that's reflective of as if that were a tech company. Interestingly, right now, some tech's halo has waned, and if you were to just obfuscate like a public filing of a fast-growing tech-enabled retail business and a normal consumer tech company, it might be hard to tell the difference, right? But I think that's also just because perhaps some public money has over-rotated into like staple stocks that feel a bit more safe. So I'm not sure what that looks like in several years.
Yeah, when we were speaking we knew it was untraditional to go down the venture path when we were raising money for Blank Street. So the one thing we did was to really try with our data to express that this business, when you look at it from a ROIC perspective, looks no different than a consumer technology company or a direct consumer business that they're used to investing in. And so even though the units of measurement are different. We're not looking at a customer cohorts. We're looking at store cohorts. We're not looking at marketing costs to acquire your CAC. We're not looking at that, but we're looking at the build out cost of the store. Ultimately, return on invested capital is return on invested capital. And if you're looking at a business with a very high return on invested capital, despite it being capital heavy, capital intense, it still is a much better predictor of like future growth than anything else. And so what I guess Left Lane saw. I think it's one of the smarter things we had done at the time was to really just paint the picture through a dashboard that they were super familiar with and were able to like understand what the IRRs of the location was and what the long-term growth rate of the business could look like. But yeah, another great thing about retail businesses is, as opposed to other consumer brands, like we don't spend money on marketing. Like our marketing is a build-out cost. And so even though it feels capital intense, like ultimately a consumer company is spending more on marketing than a four-wall concept spending on building stores. Like who's more capital efficient, right? So there is this presupposition that it's capital intense, but ultimately a capital efficient business is one that returns capital very quickly on the upfront costs needed to do it.
Does anyone have a question for Scott or Masterworks or the broadly speaking the world of contemporary fine art?
I have a question.
Okay.
Yeah, actually, so what do you think was the psychologically the consumer insight as to why consumers are okay with buying a fraction of a piece of art that they might see maybe once a year or just have their names associated to it
It was just an investment thesis, right? It was that if you look at the performance of the asset class, it outperforms other asset classes. So it doesn't. It's interesting. Like if you look at people who like art, our financial advisor team negatively scores them, right? So people who like art are unlikely to invest in Masterworks. Wow. The good news is 99% of people don't know anything about art, so that's like our market, right? But yeah, there was never a thesis that people, have a connection to the object or want to hang it on their wall or have an affinity to that artist. It was just purely financial.
Okay. Anything else from folks in the room? Yeah, sure.
Just kind of curious for Masterworks. If you think about network effects, how does that kind of impact your business? I think obviously with crypto and NFTs, I think the boom was, in my opinion, driven in large part by the network effects around.
Yeah, it's like network effects in financial services it's actually very complicated. So there's a bunch of academic research on how NPS is the wrong metric, and we see that often. I think the challenge that we have with network effects is that our investment vehicles are very long term, so they're 3 to 10 year vehicles, and we generally see people refer friends when they receive a cash on cash return, independent of appraised value. So it for better or for worse is kind of a long term network effect dynamic. Yeah,
I mean, I'd call it a feedback loop in a way, like what
long-term feedback loop. Yeah,
and I think you all have done some special things as far as building out your own proprietary data set, understanding what artist markets are trending, and I think that informs a lot of your buying and selling decisions. Won't get into the sort of secret sauce of it. So I wouldn't call that network effects. I define network effects as like my being an investor, not in Masterworks, but as a retail investor. Yeah. Would make Issam's experience better or worse, right? In the classic conventional sort of marketplace dynamic. And so I don't know if I would call it network effects, but I would call it sort of what's a defensibility or moat that would just preclude someone else from coming and trying to do what you all do in an effective way. All right, I'm being told I think we're up on time. Thank you so much for hanging with us.